Thank you for joining us today. We're going to cover three topics that seem to be top of mind for everybody in commercial real estate: recession, inflation, and what it means for real estate. Let's begin with a discussion of recession. The technical definition of recession is 2 quarters of economic decline. That means 2 quarters where the GDP falls, and then there's some other elements such as a rise in unemployment. Well, GDP, real gross domestic product, decreased at 1.6% annual rate in the first quarter of 2022. That's based on data from the Bureau of Economic Analysis. And then looking at the second quarter, obviously it hasn't been published yet, but the Atlanta Fed does an estimate. And their estimate was, using their model GDP now, that we would see another decline, that it would be about 1.5%. This is their estimate as of Friday. So what does that tell us? It tells us that those 2 metrics for recession truly have occurred. The second big item to watch is unemployment. Well, we peaked at unemployment in April of 2020, and then it's declined the last several months. It's been at 3.6%. Let's take a minute and look at that for a moment. This is the unemployment rate going back to 2017. We can see the significant rise here. It peaked in April 2020 at 14.7. And then the last several months, since March, April, May, and June, we've been at 3.6%. It's kind of flatlined. Doesn't seem to be increasing, as the case may be. One of the other factors that people look at as an indicator of recession is interest rate inversion. This is a chart showing the 10-year U.S. Treasury minus the 2-year Treasury. And it goes back, in this case, for decades. Every gray spot is a recession. Let's look at 1 year, which gives us a little more favorable feeling. Well, so think about what this means. Interest rates for U.S. Treasuries are really a function of supply and demand. There's not a whole lot of new Treasuries being issued. So how much demand is there for it? That's how the price is set. Well, there's more demand for 10-year U.S. Treasuries at the present time than for 2 years. Why would that be the case? It's because people are concerned about locking in for a longer period of time. That is an indication of fighting what they believe to be perhaps an upcoming recession. Another way to look at these numbers is FRB H15. This is the chart. And so we can look at treasuries here. It shows us the 2-year Treasury right now is, as of the 15th, was trading at 313, and the 10-year was 293. Well, that inversion is a red flag to watch out for in the economy. It means that there is a feeling things are going to change near term, perhaps in a negative way, and so there's a goal of locking in returns for a little longer. The next thing we'd like to talk about is inflation. Let's look at inflation for a moment. As you're probably aware, the latest release from the Bureau of Labor Statistics showed that inflation rose 1.3%, that was month over month, and is 9.1% for the last 12 months. CPI is the change over time in the prices paid by urban consumers for goods and services. Well, this is frightening, isn't it? To think about inflation of 9.1%, it hasn't been this high in decades. So let me add one item for you to keep in mind when we look at this. This event. This is the Bureau of Labor Statistics, a graph showing establishment survey non-farm employment going back for 10 years. Well, you can see what happened here. In February of 2020, we were at a peak, and then there was this precipitous decline. Precipitous decline. This, frankly, is what the market calls an unprecedented event. It has never happened to this magnitude before. And so we need to take this into account when we're examining some of the economic indicators and what's going to happen, because never before were we facing something like this. So when we consider that it was an unprecedented event, maybe the situation with inflation is not necessarily consistent with what happened in the past. So what's inflation going to be in the future? This is a good definition which looks at Treasury inflation-protected securities. This is a very useful measure of what the market's expectation of inflation, CPI, will be in the future. So the Treasury inflation-protected securities, TIPS as they're called, looks at U.S. Treasury bonds, and they're secure and constant maturity treasuries of the same duration. The difference of those, in essence, tells us what the market thinks inflation is going to be. So think about that for a moment. Constant maturity treasuries and then inflation-protected treasuries. The difference between those two numbers is what the market says inflation is going to be. Let's go back and look at the tools that we had, the FRB H15, and we can take a look at that. If we look at constant maturity treasuries and inflation index. So as an example, the 5-year is 3.05. The 5-year inflation indexed is 346. So we would take 305 minus 0.46, and that's what the market tells us inflation is going to be in the future. You know, something in the range of 2.5%. It's interesting to note what the market says about 10. 10-year U.S. Treasuries, obviously, are 293, and then the 10-year Treasury inflation-protected securities are 0.57. So that's even lower. For 10 years, the market is saying that inflation may be more in the 2.3 range. The bottom line for us, the market tools that we have seem to indicate that the inflation we're facing now, looking in a rear view mirror, is not what we can expect to continue long term in the future over the next 5 to 10 years. The market expectations are that inflation would return to somewhat of what we call a normalized range of 2 to 2.5%. Well, the final thing I'd like to look at is real estate. You know, we've talked a little bit about some of these elements. So real estate. There's an interesting tool we've shared with you before called Census Quick Facts, which gives us the ability to select several formal geographies and compare them together in a chart. Well, let's look at this for a moment and see what we can learn about real estate in our market. We've selected the United States to benchmark, Florida, and then 4 counties in Central Florida that we're active in: Orange, Polk, Osceola, and Lake. And as you may note, we've kind of sorted things in ascending order. It makes it easier to be consistent. What I want to draw your attention to is the change in population, the growth between April of 2020 and July of 2021. That's 476 days. So this isn't, necessarily an annual number per se. We'd have to adjust, but it's a great relative benchmark to check. You notice that over this period of time, the United States population grew by 0.1%. Florida grew 10 times that. Now, Orange County is a little bit of an anomaly. There was a decline as a result of some movement of jobs. But let's look at Polk, Osceola, and Lake County. Off the charts, 3.1 to 3.9%. What does that mean? It means that these counties, our market, is growing 30 times faster than population in the United States. And we know that real estate is space for people. More people is more demand for commercial and residential real estate. It's good for our businesses. To kind of summarize this for a moment, what does it mean? We think that the population growth is a driver of what we see as a strong economy in our geography. That's the good news. Will there be a recession in the rest of the country? Maybe so. The indicators would seem to say we wouldn't be surprised if there was a formal recession announced in the second half of 2022. We'll have to see where unemployment goes. And what about inflation? Well, we expect inflation to moderate, consistent with what the market says, comparing constant maturity treasuries to inflation indexed treasuries. And then finally, it's good to be where we are. This is an excellent time to invest in real estate and take advantage of what may be a different direction than the economy in the rest of the country. Well, thank you for being with us today. Let us know if you have any questions or if there's anything we can do to be of service. Have a great day.